Welcome to Accounting with Madam Mombi. Today we are going to be looking at CVP analysis, that is cost, volume, profit analysis. So to begin with, CVP analysis, it explores the relationship that exists between the three variables that we have mentioned. That is the relationship between cost, volume of output, and the resulting profits. It helps us to address the following questions. Like number one, we want to know at what sales volume can a firm break even. We're going to define what is break even in a few. Another question that it helps us to address is what sales volume will achieve a desired target profit. Another question that it can help us to address is what is the impact of changes in selling price, cost, volume on profitability. Simply, if you vary the variables here, probably change the selling price, how does it affect your break-even point? If you change the variable cost, how does it affect your break-even point? If you change the fixed cost, and so on and so forth, how do they affect profitability? So this is a very important tool in an organization for short-term planning. It helps a business to make management decisions based on this tool that we're calling CVP analysis. So fast forward, our CVP analysis is based on the following assumptions. The first assumption is that the analysis is either of a single product or a constant sales mix. So what do we mean here? What we are going to be looking at is either a single product where an organization is selling one product, and if it sells more than one product, we are going to be assuming there is a constant sales mix, so that the products are sold maybe 3:2, 2:3, but there is a constant sales mix. This is the first assumption. The second assumption, it looks that all costs can be classified as either variable costs or fixed costs. What does this mean? It means that all mixed costs can be broken down into their components of fixed and variable costs for the purpose of this CVP analysis. The third assumption is that there's no inflation. Here, it would mean several things. Number one, it would mean that the selling price is constant, meaning there's no change in prices of commodities. That would also mean that factors of production have constant prices. So when you say there's no inflation, it is equally meaningful to say that selling price is constant or factors of production are constant in price. Another assumption is the variable cost per unit remains constant under the period under consideration. These are not the only assumptions, we have several more. It also assumes that total cost and total revenue are linear functions of output. And you're going to see this when you're going to be looking at graphical approach of BEP analysis. Then finally, it assumes that total fixed cost remains constant within the relevant range. And I remember we defined what is relevant range. It is a range of activities within which cost can be defined. So, for example, a relevant range would be between 1 unit and 50 units. That is a relevant range for a certain cost. It would, once you exceed the critical level of 50, that cost may go up. So a relevant range is a range of activities within which the definition of a fixed cost is valid. And we are saying that therefore this is assumed that the total costs are constant at the relevant range. Alright, so this brings us to one of the key form of CVP analysis, which we are calling BEP analysis or break-even point analysis. It shows the minimum level of operations that is required by an organization for them to survive. It shows the level at which total cost is equal to total revenue, or at the level at which profit is equals to 0. So break-even point is one form of CVP analysis, and it is one we are going to be concentrating on in this lesson. So to move very fast, having understood what is a break-even point, we have said is a point of activity where total revenue is equals to total cost. And if total revenue is equals to total cost, definitely, that means that profit is equals to 0. There's no profit. So we are saying that one approach of BEP analysis is a graphical approach. So as we have said that break-even point is a point of activity where total cost is equal to total revenue. And remember, one of the assumptions of BEP is that total revenue and total cost are linear functions of output. So if we graph on a graph, here having output or the sales volume, and on this other side, on the y-axis, having total cost and total revenue, we can be able to draw these curves. The curve in starting from the 0 axis, starting from 0 is the total revenue. Definitely, if you do not sell anything, then you have no revenue. Therefore, this total revenue curve starts at 0. It is starting at 0. But for the total cost, it is starting at a point above 0, because we have said that you have fixed cost, which is represented here. So the total revenue, the total cost function or line drawn on a graph is going to start at a point above 0 here. This is the total cost function. Definitely, part of this is variable cost, or the other part of this is total cost, while the other part is variable cost. While the two of them intersect, that is the point we are calling the break-even point. So for you to be able to achieve this, you need a good graph paper. Then you can be able to graph the data. We have said on this side you have the sales volume stroke the output. On the other side, on the y-axis, you have total revenue and total cost. Also, you can also draw what you call the profit chart, PV chart or PV graph. So it is a profit and volume graph. So on this side, you're going to have the sales volume, while on the other y-axis, you're going to graph profit and losses. That is starting from the negative, which is the losses, to the positive, which is the profit. This is expected that the graph will start from the negative side, that is the losses. But when it touches the x-axis, at this point, this is the break-even point where profit is equals to 0. And you can see here, it is going to be reading 0. The profit is going to be 0. So before that, at this area, you're making losses. Above this, from this area, you're making profit. So again, this is a graphical approach that we can use to determine the break-even point. So the other approach we can use is mathematical approach. The first mathematical approach we are going to use is algebraic approach. Not so hard of algebra here. We just are going to equate total revenue to total costs at the break-even point, meaning total revenue is equals to total cost, giving us profit of 0. And this simply means that if we break down what is total revenue is the multiplication of the selling price per unit multiplied by the number of units. That gives you total revenue. Total cost, it is the sum of total fixed costs and total variable costs. Now, total fixed cost is what we have here. Total variable cost is again given by variable cost per unit multiplied by the number of units. Now, forming this as an equation, as you are going to see in our question in a few minutes, we can be able to use this formula to determine the break-even point, which now we are calling here algebraic, using algebra. So, another approach, mathematical approach, is the contribution margin approach. In this approach, we can start by defining what is contribution margin. Contribution margin is simply per unit, the difference between selling price per unit and variable cost per unit. That is how you get contribution margin per unit. So for us to get the break-even point in units, we are going to use this formula, which is equal to total fixed costs over contribution margin. And for us to get the answer in shillings, we are going to say it is equal to total fixed cost over contribution margin contribution margin ratio. Now, you may be asking yourself what is now contribution margin ratio. We just introduce a denominator to the contribution margin formula. So as we had here, selling price minus variable cost, here it is selling price minus variable cost, but over selling price per unit. So introduce a subscript or a denominator. Sorry, a denominator, yes. So these two formulas, again, in the mathematical approach, as we are going to see in our question, can be used to get the break-even point, which we are calling the contribution margin approach. But then you can also answer the second question, which was asking, what sales volume will a firm achieve a desired target profit? If the target profit is before tax, we are going to use this first formula, whereby fixed cost plus target profit before tax over the contribution margin. But if we want to get the target profit after tax, we are going to use this formula, where it is fixed cost plus target profit after tax. On this target profit after tax, we add a denominator below it, which is 1 minus tax rate. Then all of it, you put another now denominator on all of it, which is the contribution margin. So those are the formulas, and there is not much that can be explained in a formula. The only way to understand this is to do a question. So this brings us to our question here. And before we go to the question, let's look at something we call margin of safety. How safe are you? When you talk about margin of safety, is how safe are you? So it is the difference between the actual sales and the break-even sales. The higher the margin of safety, the safer the situation. Rather, it is less risky if you have a higher margin of safety. What we are saying is that if actual sales maybe is 5,000, while your break-even point is 2,000, meaning there's a margin of safety of 3,000, that is a safe situation because you have a lot of units above the break-even sales. You can also get that in a form of a percentage by using this formula. Having given these formulas, we are saying let's come to our question, which we are going to be doing today. This is the example. It reads that the following relates to product Z of ABC Limited, whose selling price per unit is shillings 800. Variable manufacturing cost per unit is shillings 380. Variable selling cost per unit is 2.5% of the selling price. Total fixed cost is a total of 1,200,000 required. Break-even point in units and in shillings. Number of units to be sold to earn 500,000 before tax profit. Number of units to be sold to earn 500,000 after tax profit in a tax rate of 30%. And finally, if actual sales are 5,000, compute the margin of safety. So I want you to have a copy of this question so that we can be able to compute it. So you can take some time and have a copy of the question so that we can be able to compute it. To answer our question, we have seen that from the question that the selling price per unit is equals to 800. We have also seen that the variable manufacturing costs per unit is shillings 380. We are saying this is per unit. But you have also been told that there is a variable cost selling which is 2.5% of the selling price. Remember, the selling price is 800. This is going to give us 20. Therefore, we can say that total variable cost per unit, in total, it is the sum of 380 plus 20, giving us total variable cost of 400. That is the total variable cost. Finally, you have total fixed cost. Well, this is total variable cost but per unit. Now you have total fixed cost, you have been told is 1.2 million. Like that. So this is just a brief summary of our question. So to begin with, we can start with the algebraic approach. In algebraic approach, we have said, it is simply, you say, at a break-even point, profit is equals to 0. Therefore, you are going to equate that at 0, it is equals to total revenue minus total cost at 0. This is using algebra to get the break-even point. So you are going to further say that 0 is equals to total revenue is a multiplication of selling price and the quantity. And we do not know the quantity. That is what we are looking for. So it is simply 800 Q. Q representing quantity minus total cost. Total cost, we have said it is the sum of fixed cost and variable cost. Fixed cost we have here is 1.2. While now variable cost, it is you multiply variable cost per unit multiplied by the number of units. We do not know how many units we need to sell to break even. That is what you are looking for. So this is going to give us 400 Q. And I've just broken this into fixed cost plus variable cost. Both of them in total. Total fixed cost, total variable cost. So if you open this, it is going to give us 0 is equals to 800 Q minus 1.2 M minus 400 Q. Then if you take 1.2 here, you are going to be left with 800 Q minus 400 Q, which is 400 Q. That is 800 minus 400. Then you bring this to this side, meaning if it is negative here, it becomes positive here. So to get Q, that is a break-even point, sales in units, it is equals to 1.2 divided by 400. So that is how you get Q. Divide by 400 here, divide by 400 here, which is going to give us 3,000 units. So this is the first approach that we can use to get the break-even point. And we are saying this approach is what we call algebraic approach, which was our first approach. Now we can come forward and look at another approach, which is the break-even point approach. I mean CVP approach of contribution margin. So we can have here another approach whereby break-even point is equals to, we have said, fixed cost over contribution margin. And we have said that contribution margin, CM, is equals to per unit, selling price per unit, minus variable cost, all of them per unit. So using this formula, if we want to get the BEP here, but in units, we are going to say fixed cost. How much is our fixed cost? Fixed cost is 1.2. We have it here. Total fixed cost is 1.2 million. Then contribution margin, what you are saying, CM, it is the difference between selling price. Our selling price there per unit is 800, and our variable cost per unit, is 400. You can see it there. Again, this is also going to give us 3,000. This is going to give us 3,000 units. So this is how we get break-even point in units. Now, we can also get the break-even point in shillings, BEP, but now we want the answer in shillings. It is equals to fixed cost over CM ratio. Now, if you want to get the answer in shillings, you change this from just CM to CM ratio. So we are going to have our fixed cost still remains to be 1.2 million. The CM ratio, as we have seen in our formula, it is the same. It is selling price minus variable cost, but now over selling price. So we are going to have is 800 selling price per unit, variable cost per unit of 400 over 800, which is the selling price. So that is what you're calling a ratio, contribution margin ratio. This is what you're calling the contribution margin ratio. This is going to give us an answer of 2.4 million. The answer being in shillings. And that is how you get the break-even point in shillings. Alternatively, you can say that BEP in shillings is also equals to BEP in units multiplied by the selling price. That's another way of getting the break-even point in shillings. In our question, once we got this BEP here as 3,000 units, we can say if BEP is 3,000 units, we would have simply multiplied by the selling price per unit, which we are remembering is the first thing there is the 800. And simply by multiplying the break-even point in units with the selling price, it would also have resulted into us getting the break-even point in shillings, which we have said is 2.4 million. So that is the first question. We have done just one part of our question. The first part of our question was asking us simply to get the break-even point in units and in shillings. And we have agreed that we can use algebraic approach where we look for Q. Q is the unknown. Or we can use the contribution margin approach where using this formula, which is fixed cost over contribution margin, we can get the break-even point in units. If we simply multiply that with the selling price, we can get the break-even point in shillings. Alternatively, we can use this formula, whereby now, instead of having contribution margin here as a denominator, we have contribution margin ratio. And then simply they are going to give us the same answer. But our question does not end there. We also asked in our question the number of units that can be sold to earn a target profit of 500,000 before tax. And our formula, we said that to get the number of units that can be sold to earn a target profit before tax, the formula is equals to fixed cost plus target profit. Before tax. Target profit before tax over contribution margin. Now, from the details from our previous question, which we have here, there, you can see that the fixed cost here, which I'm talking about, is 1.2. Remember, we are answering the question that as how many units should we sell to earn a certain target profit, here being 500,000 before tax. All these other details are the same. So, coming back to our answer, we are saying here, if the fixed cost is 1.2, then we are going to add the target profit before tax, which is 500,000. Then all this over contribution margin. Remember, contribution margin is simply selling price per unit minus variable cost per unit. So giving us, this one is going to give us 4250 units. So those are the number of units we need to produce to earn a target profit of 500,000 before tax. Finally, or at least not finally, but as also our question is also asking us, how many number of units can we sell to earn a profit after tax? The same profit, but now after tax. We are saying it is fixed cost plus target profit after tax. Then this, you say 1 minus tax rate over contribution margin. So we are going to simply also again put our figures from our question. So our fixed cost still remains to be 1.2. Our target profit is 500,000, but now we want this amount after tax. So we are going to say 1 minus tax rate. We have been told in our question that the tax rate is 30%, which is the same as 0.3. So this part is the only one we are putting, and this denominator. Then all of it over contribution margin, which we have said is 800 minus 400. $800 over 400. So again, this one is going to give us 4785 point something, 0.7, which approximately is 4786 units. And we have answered up to number 3 of our question. So our final question is the margin of safety. Margin of safety. Margin of safety. We said margin of safety, MS, is equals to the actual sales minus BEP sales. So that we had been told in our question that imagine the actual sales is 5,000 units. And we have computed that the break-even point sales is 3,000 units. This means that our margin of margin of safety is 2,000 units. So we are above the break-even point. We are above the break-even point by 2,000 units. We can also get this as a percentage, which is going to be 5,000 minus 3,000 over 5,000. And this can give you the answer now as a percentage. If you compute that, it can give you the answer as a percentage. So this is how you compute our question on break-even point, but where you have one product. So in our next section, we are going to look at break-even point, but where you have a multi-product scenario, where you're selling more than one product. So if you have liked and found this important, kindly like, share and subscribe. Look out for part 2, where we are going to be looking at multi-product, where you have more than one product, BEP. Thank you.